Investment flash.
Stocks are pricing perfection, but there's a safety valve. And it's not gold, it's the rotation trade. I'm Tom, and this is Investment Flash.
It's Friday, July 24th, the New York edition, with Gerald and Tom. I'm Marie. Today's takeaway: stocks are pricing perfection, and the rotation trade is the safety valve. And that warning from BofA's Sebastian Raedler is ringing loudly. He says investors are ignoring stock market risks, leaving no premium.
Yeah, look, when the strategist is sounding alarms while stocks are near highs, it usually means one of two things. Either he's early, or everyone's just hoping the music doesn't stop.
But Gerald, the music isn't stopping, it's just changing the playlist. The industrial ETF surged nearly 2% last session, while the S&P fell over 1%. That's rotation, not retreat.
Hold on, that's exactly my point. The market is pricing perfection on the hope that the trade war resolves, that the Fed doesn't hike, that AI capex doesn't implode. It's a lot of ifs.
Right, and if ifs were dollars, we'd all be hedge fund managers.
Oh, come on, Gerald. Your bond doom loop returns. But seriously, we called the industrial ETF yesterday, and it's already paying off.
Yesterday's call? Tom, it's one session. I've seen value traps spring and snap in a week.
No, but think about it. The insurance ETF has a trailing PE of just 11.6. That's not a trap. That's a value play while everyone's obsessing over AI.
Exactly. And with the AI sell-off leaving the broader market unscathed, the rotation could accelerate.
Fair enough, but let's not forget the elephant. US just slapped tariffs on 60 countries. China, Japan, the EU, that's a growth killer.
And the China ETF is down about 14% year to date, near lows. If Beijing retaliates, that could deepen.
So short China? I'd rather short Mexico. The Mexico ETF dropped over 2% just yesterday, and they're in the crosshairs too.
60 countries, and the only thing not tariffed is Swiss chocolate. Probably next.
Don't give them ideas.
But seriously, the Japan ETF is up about 12% year to date. That could unwind fast if trade tensions escalate.
And the yen is already getting hammered from outbound mergers and acquisitions, near a 40-year low. The yen ETF sits at its 52-week low.
So we've got a sell on China, Japan, Mexico, and the yen? That's a trade war basket.
The Nikkei report on foreign acquisitions pushing the yen lower, that's structural selling, not just sentiment.
Right. And if the Bank of Japan stays dovish, there's no floor.
Spot on.
Totally.
Speaking of floors, gold is looking shaky. The gold ETF fell 2% last session, down almost 7% year to date.
Gold at $4,100, and with oil surging, rate hike bets are climbing. The dollar's strengthening, it's a triple whammy for gold.
See, Gerald, that's the thing. People think gold is a safe haven, but in this environment, it's just another risk asset.
The safe haven that's down nearly 30% from its high? Not very safe.
Honestly, my mattress has better returns.
Fair enough.
But the real story is oil. The U.S. oil fund up over 100% year to date, and Japan is now trying to build naphtha reserves after the Hormuz disruption.
That's a crowded trade, Tom. It's already priced in severe supply tightness. Unless we get an actual shutdown of the Strait of Hormuz, further gains are tough.
I'm going to push back here. Japan building reserves means they expect more supply shocks. That's a signal.
Exactly, Marie. It's not just about what's priced in. It's about the precautionary demand. Buy on dips.
All right, buddy. But when WTI slips below 90, don't forget my crowded trade warning.
Let's shift to crypto, because Bitcoin held near $65,000 during an $800 billion AI sell-off.
That's a decoupling. For real. Bitcoin barely budged while tech got hammered.
Decoupling. It held for a few hours, buddy. Let's see a month of AI selling before we call it a safe haven.
No, but it's not just that. BlackRock, Coinbase, and Strategy are part of a $15 million consortium for quantum-resistant Bitcoin. That's signaling long-term commitment.
And the Bitcoin Strategy ETF is down around 30% year to date. If sentiment turns, that's a huge snapback.
Tom, you've been calling a Bitcoin snapback since it was 20,000. Oh, wait, it wasn't that long ago.
I know, but this time it's different. It's got BlackRock.
The BlackRock seal of approval, like a good housekeeping stamp.
To be fair, the Coinbase angle is interesting. They're involved in the quantum consortium, and their stock is down over 30% year to date.
But the trade isn't just crypto. It's also the logistics merger in Europe, Argon and WDP, creating a nearly €15 billion group.
Argon surged more than 15% last session. That's a deal pricing in some serious synergy.
Or just momentum. It's within 1% of its 52-week high. WDP fell about 2%. Maybe there's dilution risk.
Wait, but that's the asymmetry. WDP's drop could be a buying opportunity if the deal completes and synergies are real.
Merger arbitrage, where patience pays, or regulators crush your soul.
Spoken like a true value investor.
All right, let's hit the most original take. The journal highlights IBM CEO. He's not worried about the AI sell-off, doubling down on mainframes and quantum.
IBM as a safe haven in tech? I love the contrarian play. Legacy giant with real moats while the Magnificent Seven bleed on CapEx.
Now, IBM's been a value trap before, Tom. Remember when Watson was going to cure cancer? Yeah, how's that going?
But the quantum push is different. If AI spending fatigue hits, businesses might lean on reliable mainframes. It's a hedge.
Exactly. Not everyone needs to build their own AI. IBM could benefit from the disillusionment.
Fair enough, I'll give you that. If they execute on quantum and mainframes, it's a differentiated bet.
Now, our view, the market is splitting into two narratives, fear and hope. The BofA warning and tariffs versus the broadening rotation.
And the cleanest expression, long the industrial ETF, short the S&P 500, a pair trade that bets on the rotation while hedging a broad sell-off.
Exactly.
That's the whole story.
Nailed it.
But the margin for error is thin. If the Fed pivots dovish on those oil-driven inflation fears, gold and yen shorts could reverse violently.
And where is the Fed, by the way? Oil at 139, energy costs surging, and crickets? That's the gap.
They're probably workshopping new adjectives. Transitory 2.0.
Surging but manageable.
All right. As always, none of this is investment advice.
We're back tomorrow morning, 10 a.m. London time, for the weekend edition. If you're just finding us, hit follow on Spotify or check investmentflash.com for the full digest with charts and sources.
Until then, keep your rotation game strong.